We're continuing to see stock markets struggle in the middle of the year. The last few weeks, we've quite clearly seen momentum waning across stock markets globally. The last few weeks in particular, we've seen them pulling off those highs, and rather than moving on to make new highs, rather than seeing those dips being bought, what we're actually seeing is the rallies being sold into. As you can see highlighted on the chart here, this is the Dow in the US, or the US 30 as it is on the Oanda platform. And we've recently, it appears, made our third consecutive lower peak. So that suggests that these rallies are being sold into earlier and earlier. Now, there is a strong level of resistance just below where we're trading currently. Currently, we're trading around 25,500. 25,000 is a big level for the Dow. It was a huge, significant psychological level on the way up, and it has proved to be quite a significant level of support more recently. If we can break and hold, and I think the hold is crucial here, if we can break and hold below 25,000, that may suggest that we are heading for a little bit of a correction. Now, there's nothing wrong with a correction in these markets, and I don't believe we would see anything more than a correction at this moment in time. Ultimately, we do have far too much central bank and government stimulus, in my view, to see any massive dislocation in the markets that would trigger another March-like scenario. So the question would simply be how big a correction we are going to see. And that's assuming we are going to see one, because I do believe that stock market bulls are going to be very reluctant to let this correction happen. Again, the amount of stimulus in these markets, the amount of monetary funding in these markets is unprecedented. And with that tends to come these little bubbles that we are already seeing, particularly in stock markets, but also elsewhere. So it is going to be an interesting battle between what would typically seems to now be leading towards a corrective move and those looking to hold the 25,000 level. As you can see on the chart, though, we have seen a break of this 25,000 level once already, but within the same day, despite the fact that it broke by 500 points back towards the 24,500 mark, by the end of the day, we closed back above the 25,000 mark, and that did hold. So I still think the 25,000 level is crucial at this point. If we do break and hold and close below this level, then it could be an interesting development over the course of the following couple of weeks. Now, the level of highlighted below is 23,000. That isn't quite the size of the opening of that descending triangle that we've seen from the peak until recently, which is around 2,500 points, but it's not too far off. And 23,000 has previously been, as you can see, a significant level of support and resistance. So this is the area that I think would become most interesting to the downside should we reach these levels, and where we could potentially see people becoming a little bit interested once again. As I say, nothing at this moment in time suggests that this would be anything more than a correction should we see it materialize. And there is a number of support levels like 25,000 on a number of other charts, which could potentially break at the same time, and which could further exacerbate any move to the downside in the shorter term. And we've highlighted these on previous videos as well, 6,000 in the FTSE being a prime example of that. And this is true across a number of other indices as well, which should make the next couple of weeks all the more interesting. As I say, this has coincided with these reopenings going less smoothly than hoped in a number of states in the US, but also a number of countries as well around the world. Here in the UK, we are seeing restrictions being reimposed in Leicester, for example. And I expect there's going to be other regions where we are going to see targeted restrictions reimposed as the number of cases spikes, in order to deal with any fresh outbreaks, to stop them becoming national outbreaks and keep them regionalized. But again, this is going to slow the recovery. This is going to slow any V-shaped recovery, which I always thought was unlikely and continue to think is unlikely. And this is going to make it maybe a little bit of a slower recovery, but that's not the end of the world. And as long as these outbreaks remain within regions and are cut off very quickly, then I do think we will start to see signs of a recovery into next year, and that will sustain these stock markets. It's only when these restrictions become more national that I think we could potentially see the need for more stimulus as far as central banks and governments are concerned. And that's another thing that will continue to support these stock markets. Governments and central banks stand prepared to do much, much more if needed, and that is going to be encouraging as far as investors are concerned.